Well, good morning, early afternoon to everyone. Thank you for attending the Entrepreneur U program hosted by the City of Grand Prairie. My name is Kay Brown Patrick, and I have the pleasure of serving as business manager for the City of Grand Prairie's Economic Development Department. I hope you all have enjoyed the Entrepreneur U series. We've had several series and sessions up to this point, and next month we kick off our Franchise U series, which is about franchising. Today's topic is tax considerations for your small business. And we have Kendall Marshall from Clear Choice Financial Group with us today. I myself am excited to hear from him, and I hope you all are as well. The information and presentation will be provided to you all after the presentation, and as well as a survey. If you have any questions, please drop them in the Q&A tab, and I will get to those and present those to Kendall at the end of the presentation. So with no further delay, Mr. Marshall, I'm going to hand it over to you.
Okay, thank you, Kay. First of all, it's just exciting to be here, and always exciting for me to be able to share something that I have a passion about. And that passion is to work with entrepreneurs to make sure that their businesses are successful. So I'm excited to be here. I'm excited for this event that Grand Prairie is putting on for entrepreneurs. When I first started my business, I didn't have anything like this or anyone really to talk to concerning when I had questions concerning my business and the forming that business. So I want to share my screen out with you and look at a couple topics that we're going to discuss. First of all, we're going to talk about the choice of the entity. Also, then we'll probably look at cash versus accrual method and employees versus independent contractors. But also I want to talk about the pros and cons of having these different type of entities. In the description, I found this very interesting, and it's so true that in the description part of this, it says that small businesses are often confused, business owners or businesses are often confused when it comes to tax implications of choosing a business entity, and that is so true. And the reason that that's true is because a lot of entrepreneurs will try to go out and set up their own business themselves instead of actually reaching out to some type of professional service or a tax attorney or even a CPA in order to assist them with setting up that business. And so I just like to encourage each of you that if you set up your own business, I encourage you to reach out to some type of legal service, some type of professional, whether it's a tax consultant, a tax attorney, or a CPA, and to have them to go over your business formation with you just to make sure that everything is set up correctly. The second part of that, it says, additionally, it says once up and running, businesses owners run into potential pitfalls with prior reporting. And that statement is true too as well. Most small business owners, they get up and running, and before they actually get their business moving, you have violations that comes in from the state, also from the federal, and so 9 times out of 10, that business ends up being shut down, or they end up being assessed all of these different penalties because there was certain things that they were not aware of. So I want to make sure that we cover some of those things in today's sessions, but also I want to make sure that I leave enough time for you guys to ask any particular questions that you have for me. Let me share out my other screen, just 1 second. And I want to make sure that you guys are able to see the screen. Okay.
Yes, I'll get some thumbs up.
Okay, that's a thumbs up. Okay. So many of you are business owners, and I don't know, we didn't do any poll question or not. I don't know how many of you maybe considered or classified as a sole proprietorship, or if you classified as a partnership, or you're a single member LLC, or you're S Corp or C Corp. But in the formation of these entities, you want to make sure that you understand the difference between each one of those entities and also what is required when it comes from those entities reporting their business income as well as business expenses. So the first entity I want to talk about is the sole proprietorship, or considered a single member LLC, or you could have also a spouse-owned business too as well. They would also file as a sole proprietorship. So with the sole proprietorship, really there's no formation that you have to go through with the sole proprietorship, unless in that you are trying to set up like a DBA and then get that DBA certified through the state of Texas. Then there's some paperwork that's there. But for sole proprietorship, anyone that has an idea, that has this business entrepreneur spirit, can actually start a sole proprietorship. And so the sole proprietorship that one will start, that business is actually tied to your personal tax return. So that's what you're actually seeing here when it talks about the accounting and the bookkeeping for this business or sole proprietorship is actually tied to your 1040 tax return. And also the requirements from the state perspective, there is no requirements as to if you have to file, for example, franchise taxes, which were due yesterday. So I don't know how many of you who are LLCs or S corps or C corps, but your franchise taxes were due on yesterday, and you want to make sure, if you haven't done that, you want to make sure to go ahead and go out there and start that. File those franchise taxes. So as far as the bookkeeping and accounting, the first bullet here says accounting is less involved when you than a partnership or corporation, and also we call double entry bookkeeping. I don't know if many of you are familiar with double entry bookkeeping, but every transaction when you're doing accounting has two entries. And so that's what it's making reference to when it talks about double entry bookkeeping, is that every transaction has two entries. Well, that's not so for if you are a sole proprietorship. So from a sole proprietorship, you actually have this is a credit or this is a debit. When it comes to say spouses that have a business, uh, um, then those spouses can either elect to be treated like they're a partnership, or they can be elect to be treated like a non-LLC business owner, means that they both individually will file what we call a Schedule C, which would be the reporting of their business income and also the expenses. I see that there's a question that's out there. Kay, how do you want to proceed with this? Do you
You
want
can
to ask
answer it.
questions at the end, or you want to stop and ask questions now?
Yeah, you can go ahead and answer that one because this is applicable to the topic right now.
Okay, let's see here. Now, I don't see,
They're wanting to know why two entries.
well, why two entries? So when you're using or utilizing, for instance, like QuickBooks, then every transaction has a debit and a credit. So this goes back to your accounting equation that assets is equal to liabilities plus owner's equity. So in order to keep that equation balanced, then one transaction has two entries, and those two entries will actually keep that equation balanced. Now, if you're a sole proprietorship, that is not so. You're not required to have a double entry or do double entry bookkeeping for a sole proprietorship. Not saying that you can't, but the reason you do the double entry is that so that your financial reports will come out correctly. So then what this is making reference to is that because you do not have a balance sheet, and that balance sheet is the same as that accounting equation where you would see assets is equal to liability plus owner's equity. When you have a sole proprietorship or a single member LLC, you don't have a balance sheet, or a balance sheet is not required. But if a balance sheet is required, then you will have to have a double entry accounting system. I hope that answered that question on that. Now let's talk about the fringe benefits. Um, The fringe benefits are kind of different as you go from entity to entity. When you have a sole member partnership, there's not a whole lot of fringe benefits that you can implement into the business itself. So then you would have to be a partnership or S Corp or C Corp or multiple member LLC where you would actually see those different fringe benefits that you can implement into the company. So there are some exceptions, and one of the exceptions, as you see here, is when it comes to health insurance. Health insurance is deductible for employees of a sole proprietorship, and also is deductible for owner and family members of a sole proprietorship. So that is a fringe benefit that you can implement into a sole proprietorship. Is that the healthcare coverage would be deductible, and then also sometimes that child care coverage can be deductible too as well. Uh, the liability part of that, when you're a sole membership, falls on you personally. And that's something that you definitely want to keep in mind, that if you're a sole proprietorship, that liability falls on me personally when it comes to the creditors, when it comes to the debt of the business, then I can be held liable and I can be sued. So I advise a lot of my clients who are just starting out, they may want to set up a sole proprietorship, but I always try to advise them to move that and let's set up a single member LLC, which kind of works the same as a sole proprietorship. A single member LLC is considered a disregarded entity, meaning that the filing and the reporting of the business income and expenses are all going to happen within the personal tax return, and that's going to be on your Schedule C or your Schedule F. Are there any questions on that part? One other thing I want to point out when we look at a sole proprietorship is that you want to make sure from an accounting standpoint that you do not commingle your business and your personal uh, uh, purchases for the business, that you don't commingle those funds or those transactions. You definitely want to do that. You want to definitely keep your business separate from your personal. One way that I have my clients to set it up is that if I have a business and I have my personal account, if I need to move money into my business account, then I do a transfer from my, if I need to loan the business money, I'll do a transfer from my personal account into my business account. And in the memo part of that, I would indicate that this is an owner's contribution. If I'm pulling money out of my business account and I need to move money into my personal account, then I will do a transfer from my business account into my personal account. And in the transfer or in the memo part, I would actually indicate that that's an owner's draw. I see that there's another question that's out there.
So can a single member LLC deduct health insurance?
Yes, they can. So you can deduct your health insurance coverage as a single member LLC. That deduction of the health coverage is considered to be an adjustment. So I don't have a tax return in front of me, but if you had your 1040 tax return, what you would actually see, the healthcare coverage, it would actually fall in the reporting area of an adjustment. So when you look at your 1040, you would see the total amount of your income or your net profit, and then you would see your adjustments. Your adjustments reduces your total income to get you to your AGI or adjusted gross income or your taxable income. So yes, that healthcare coverage is deductible. Now the next entity type, and again, this is a comparison chart. Listen, feel free, and I'm going to share this, or I'll drop it into the chat, or Kay will actually get this information out to you. But go through this and actually look at your entity and look at what's required from accounting to bookkeeping to what is deemed to be fringe benefits, and then the liability part of that. So that kind of will help guide you into that, I need to be set up as an S corp, or I need to be set up as a multiple member LLC, as opposed to a sole proprietorship, or even as opposed to a partnership. So now when it comes to setting up a partnership, the partnership, unlike a single member LLC, unlike a sole proprietorship, the partnership files its own tax return. And the tax return that that partnership files is a 1065. So the partnership will file its own tax return. And then the partners themselves will actually receive a K-1, which will then be read into their personal tax return. So if you're a partnership, you're going to file Form 1065. That's the tax form that you will file. And that partnership will file its own tax return, although the partnership itself doesn't pay taxes, but it reports the income of the business on a tax return. Now, when it comes to the accounting piece of that, then and bookkeeping side of that, then we see that in a partnership, the financial reports that are produced are your P&L, which is your profit and loss statement, and also your balance sheet, which shows your assets, the liabilities of the partnership, and also the equity part or the capital investment from each one of those partners. Now, you do have some fringe benefits when it comes to a partnership, but you are kind of limited on what you can and can't write off as a fringe benefits in the company itself. Most of that information is recorded on the business K-1 and is passed through to your personal tax return, and those deductions are taken within the personal tax return. One of the most important notations for you guys is that when you have a partnership, you will have a general partner, and that general partner will be responsible for the liabilities of the company. So keep that in mind. You could have a general partner and you can have limited partners. If you are deemed as a general partner, then you're going to be responsible for the personal liabilities of the business. So you definitely want to be careful with that. You definitely want to understand that when you're going into business with someone, that if we're setting up a partnership, who's going to be a general partner? I may be a limited partner, meaning that I'm just going to financially back the business, but I'm not going to be a part of the operation of the business. Then I'm then characterized as a limited partner and not a general partner. If you don't mind, do we have any individuals that are part of this that have a partnership set up? Okay. The next company or entity I want to take a look at is a S corp. Now, your partnership, as well as your S corp, or as well as if you had a multiple member LLC, all of these are considered to be pass-through entities, meaning that the business itself will file a tax return, but the business doesn't pay taxes. All of that is passed through to either the partners, if it's a partnership, or if it's a multiple member LLC, then you're classified as members. If you have a S corp, then those individuals are classified as shareholders. And there's a big difference between being a shareholder versus being a member of an entity. If you are a multiple member LLC, then you're classified as a member. And as a member, then you can set up and define how much of the profits, as well as how much of the losses each one of the members will receive. You can proportionally set that up. And also, the unique thing with having a multiple member LLC is that if you want to change that, you can. As change as how much of the profit as well as how much of the losses each individual will receive. For example, if I was setting up a multiple member LLC and the members were all funding the putting in capital, and then we may come to the conclusion in our operating agreement as to how this company is going to operate and function, that the individual who puts up the most, then we're going to repay them back first. Then we're going to give them a larger percentage of the profit or larger percentage of the losses of the business. That's important because that information is passed through to your personal tax return. And if your business has losses, then those losses potentially can reduce your income or other income that's within your personal tax return. So as a S corp, then when we look at the accounting and bookkeeping, then we see that the double entry bookkeeping is required when you're an S corp, and that simply is because of the financial reports are being produced by the business itself. So the financial reports is your profit and loss statement, also your balance sheet, your cash flow statements, your equity statements. There are different financial reports that are produced when you're an S corp. In order to have those correct reports produced, then you would set up a double entry bookkeeping system. Do we have any questions on the S corp? Or do we have anyone on that have an S corp? Okay. Now, the fringe benefits part of this. You remember I stated that there's a difference if I was an LLC or partnership versus being an S corp. When you're an S corp, then you are considered, the primary reason of setting up an S corp is that you can now put yourself on payroll of the business. So you can now become a W-2 employee of your business. So normally when we look at moving our clients from an LLC or maybe having an LLC reclassified, then we're doing that because of tax purposes. And also we're looking at now taking that member or taking that shareholder and actually putting them on payroll of the business. Now, so when we talk about the fringe benefit part of that, we see that you're eligible for fringe benefits, but you have to be careful that because you're a shareholder, and if you own more than 2% of the shares of the business, then a lot of fringe benefits are not allowed to you as a shareholder employee. So you definitely want to keep that in mind. I did list some of those things that are here. I did list those, but all of these are subject to the fact that if you own more than 2% shares of the business, then you are limited to certain fringe benefits. And those fringe benefits have to be reported on the W-2 that's produced by the business. Okay. And normally you would see that if you had a W-2 in front of you, you would see those fringe benefits reported on your W-2, and they would be reported in the box 12 of your W-2. You would actually see those fringe benefits that's there. I see that there is a QA question. Can a single member LLC owner pay themselves a salary? No. As a single member LLC, you cannot pay yourself a salary. You cannot pay yourself a salary because the net profit of the business of a single member LLC, the net profit itself is considered to be your salary. And on that net profit, you're going to pay what we call SE tax, which is your self-employment tax. And those self-employment tax are going to go toward your Medicare and also your Social Security. So if I'm a single member LLC, if I have my gross income is $100,000, and I had $80,000 in expenses business operating expenses. Then I have a net profit of my business of $20,000. That net profit of my business is considered to be my salary. And on the net profit, I'm going to pay taxes or SE tax of 15.3%. And that 15.3% is going to be divided into my Social Security tax and also my Medicare tax. That was a good question because I see a lot of single member LLC owners and they actually put themselves on W-2 and they pay themselves a W-2, not realizing now they're paying double SE tax. Because as a W-2 employee, you pay one half of your Social Security tax. You pay half of your Social Security tax, and also you pay half of the Medicare tax, and your employer pays half of the Social Security tax and half of the Medicare tax. So you're actually taxing yourself twice. Okay. Are there any more questions on that so far as the single member LLC and can I be an employee of a single member LLC? Now, one thing that you can do, which is it's a tax incentive, is that you can hire family members within the business. For example, when I first started my business as a single member LLC, I hired, and you can do this also if you're a sole proprietorship. I hired my son into the business. He was at the age of 9. I was able to pay him, say, a certain amount at the age of 9, maybe say $3,000. That $3,000 is an expense to the business. Okay. But also that $3,000 that I pay my son as an employee of the business. Now for him, my son, I can now take that $3,000 and invest that $3,000 into like a Roth IRA, which now can grow at compounded interest for him. So I can hire my family members, my son, my daughter. I can hire my wife into my business. And then that is an expense to the operating expense of the business. And then also there's benefits to that for the members that I hired into the business too as well. Let's see. I have a QA question. So profits are taxed at 15.3%. That's correct. Says, by the way, the chat is disabled. Could you handle enabling the chat? That's something that Kay will look at. So as stated, that your net profit is taxed at 15.3%. That 15.3% again is your SE tax. That's your self-employment and your Medicare tax. Now that net profit itself is going to be taxed again at your marginal tax rate. So then that is one analysis that we'll look at too as well. If it's time for us to move you from a single member LLC, or maybe reclassify that single member LLC as an S Corp, because that net profit is going to be taxed at 15.3%. And also that net profit is going to be taxed at your marginal tax rate. So based on your taxable amount of income and your filing status. Okay, so far as on the liability part of this, for an S Corp, here you see the shareholders liability is limited. That's good. And to make sure that it stays limited, earlier I talked about things that you don't want to do, and that's commingle your business funds with commingle business with personal. And I see this a lot happen with business owners, is that we see that they use a lot of the business income for all personal use. So you definitely want to be careful with that, because what happens is now you've actually opened yourself to allow maybe an attorney or maybe someone that's trying to sue you to actually pierce that corporate veil that's actually providing that limit liability protection to you. So you definitely want to be careful with that, because here, as it states, shareholders are limited. Our liability is limited to the amount invested plus his or her own malpractice or debt guarantees. So, but remember to keep that veil intact. One thing you don't want to do is commingle your business and personal together. Set up your business account, do everything out of the business account as business. Set up your personal account, everything that you do, or if you need to loan the business money or contribute money to the business, transfer the money from your personal to the business and make sure that you record that on your books. The other entity that we want to take a look at is the S Corp. Not S Corp, but the C Corp. So with the C Corporation, the tax return or form that's used to file is 1120. The C Corporation is an actual separate entity. The S Corp, the partnership, the multiple member LLC, those are all pass-through entities, whereas the C Corp is its own entity. So the C Corp will file its own tax return, and also the C Corp will pay taxes on its own tax return too as well. So it's totally different. With the what we call the Trump tax cuts for 2018, we see that the tax rate for the C Corp was reduced from 35% down to a flat 21%. I did have other clients who were actually paying less than 21%, but with those Trump tax cuts for 2018, they just now have a flat 21%. I did, before those changes, I had clients that had C Corps who were paying around 15% in taxes. With the C Corp, when it comes to your bookkeeping and accounting, it is a double entry. When it comes to bookkeeping and accounting, it's double entry. You will find within the 1120S that there's what we call a Schedule L in the 1120S, and that Schedule L is a reporting of your balance sheet, and it's broken into assets, liabilities, and owner's equity. Okay. Now, one thing that we can talk about before we move any further is when we get into accounting. In accounting, we talk about, well, you'll decide what your accounting method is going to be, whether that method is going to be cash method or whether that method is going to be accrual method. And the difference between cash and accrual is, when are we recognizing our expenses? When are we recognizing our income? If I'm a cash method, I recognize the income when I receive the cash. That's a cash method. If I'm an accrual method, I recognize the income when that job or when that event is completed. I recognize it as income. So then I could have, as an accrual method, I could have maybe a 30 or 60 or 90-day so far that's billing my clients. But as soon as I bill them, I recognize that on my book as income to the business. When it comes to fringe benefits, you actually have more fringe benefits as a C Corp than you do as an S Corp, or even as a partnership, or even as a single member LLC. So you have more fringe benefits. I know within my company, I have college tuition reimbursement set up for my employees. Of course, my son is an employee of my business. My mom is an employee of my business as well. So I do have certain fringe benefits set up for my employees. Those fringe benefits become tax deduction for me as a business owner, and also they're non-taxable to those individuals. So far as the liability side of that is similar to that of an S Corp, that shareholders has liability is limited to the amount of they have invested, as well as owner of malpractice or debt that's been guaranteed by those shareholders. Do you have any questions before we move any further? I know that there's a lot that we covered that's there in these three sections, and it's you definitely want to go more in depth with that as you talk with your CPA or your tax consultant, or whoever that you retain their services for bookkeeping and also in the preparation of your tax. One other thing I want to point out here too as well in accounting and bookkeeping or record keeping is that if you're an S corp or you're a single member LLC, normally you're not a physical year. Normally you're a calendar year, so it's whatever happens between January and December 31st. So normally if you're set up as a single member LLC, or normally if you set up as a partnership or multiple member LLC, then normally you will have a calendar year and not a fiscal year end. And if you're going to have a fiscal year end, you do that for tax strategies. We're not getting into any of the tax strategies that are actually centered around each one of these entities. When you look at your tax code, there's over 7,000 tax codes that are out there. A large percentage of those tax codes are used for tax avoidance, not tax evasion. So when we're setting up these different entities, we're actually looking at those tax codes that are out there and which of those tax codes that we can implement into these entities process in order that they may receive tax incentives or tax deductions for having their business in place. And that's a big tax strategy because with tax incentives will reduce your taxable income of the business. It reduces it dollar for dollar. And as I'm pretty sure that many of you took advantage of those tax incentives that were out there because of COVID. Okay.
Kendall, could you repeat? And we have a question here about LLC. Should they use a calendar or a fiscal year?
If you're an LLC, you're going to be using a calendar year, not a fiscal year. Some of these entities are limited on what they can use. For example, as stated here, and that's why I kind of put this thing together for you guys to keep. You can see here with an LLC that you cannot file as a fiscal year business unless owner files Form 1040 under the fiscal year rules. So there's a lot that applies there that if you're going to be allowed to file as a fiscal year, because you have to take in consideration, my personal tax returns are due April 15th. My personals are considered to be a calendar year. Do we have any more questions on so far as this part here of looking at the entity, looking at the accounting and the fringe benefits and the liability with each one of those entities? Probably one other note I would make that if you are a single member LLC and you have a net profit in your business of 30,000 or more, then I would look at reclassifying my single member LLC as an S corp. And I would do that in order to save on taxes. So there are some strategies that's there that I would look at. So if I'm a single member LLC, and my net profit of my business is more than $30,000, $35,000, then I would probably look at reclassifying that business as an S corp. And there are some other things that you want to consider too as well. Okay, so now in the comparison chart, I put this together, and Joy, Kay, kind of keep me on time, because there's some other stuff I want to be able to go through that's outside of this that I want us to take a look at when it comes to taxes and also with these entities. One benefit that's there as a sole proprietor and also as a single member LLC is that we have what's called QBI, or it's qualified business income deduction, QBID. That deduction can be up to 20%. So a few minutes ago, we talked about if we had a gross sales of 100,000, we had operating expenses of 80,000, and then we had a net profit of the business of $20,000. There's another deduction that can be generated, which is called QBID, which is qualified business income deduction, and it could be up to 20% of that net profit of the business, and it would serve as an adjustment or serve as a deduction as well. So there are some benefits that's there. Now this deduction here comes in play with the 2018 Trump tax cut. There's going to be a sunset on that. That sunset, I believe, is 2025. It's going to be the sunset on that. That deduction will not be offered anymore unless in Congress decide to extend it. Now I'll put this together, and here we get more into the taxation piece of that for each one of those entities. And you can, read over this, and then if you have any questions, please feel free to reach out to me or reach out to Kay, and then I would look at answering those questions for you. The next thing I want to look at or talk about are the pros and cons of these different type of entities. And I think that these two things are documents that I've put together would be your cheat sheet as to say, or guidance as to say, if I need to start rethinking the formation of my entity that I currently have. So in the pros and cons, I look at each one of these entities. Look at each one of the entities, and I identify what I consider to be the pros, the cons, and if this is a good fit for you as an entrepreneur. Also, I talk about, earlier we talked about piercing the veil of your corporation. Also, I kind of identify that and go through that about not commingling your business funds to keep that from happening too as well. So I kind of look at the pros and cons for each one of the entities for you guys to go through that and look at those. And that will also help guide you into making the selection if I should be an S Corp, or should I be a C Corp, or should I be an LLC. Some other things that can affect that is that these items I call here, these items here, investing into my pension plan, whether I'm going to hire my wife or my kids into my business, those are also tax benefits that you could implement into each one of these entities. So you want to keep that in mind too as well. And you want to work with your CPA with that too as well. Okay, was there a question or something in the chat?
No, sir.
Okay, I see that it's 12:15. Do you guys have any questions for me? I'd like to probably stop at this point and answer any questions that may be outstanding. And again, you guys will get a copy of this too as well.
And what are the penalties for not filing your franchise taxes as an LLC?
As an LLC, well, the penalty is $50. So there's a penalty that's there of $50 if you don't get that filed in time. Also, they may also suspend your entity, and then you have to now get that, go through the Secretary of State to get that reestablished, and there's another penalty that's there, and that penalty could be $75. So you have the penalty of $50 for not filing your franchise tax on time. And then if you say go another tax period, they may inactivate your LLC, and then you have to get it reinactivated, and you have to go through the Secretary of State, and that penalty normally is $75. One other thing I want to point out, and I see this here about charitable contributions, Um, and I see this commented with a lot of single member LLCs as well as S corps, is that you may want to contribute to a nonprofit through your business. If you're a single member LLC and you say you want to contribute any amount, the amount that you contribute is actually not an expense to the company itself. That amount that you contribute is actually going to be reported or itemized on your Schedule A. So you definitely want to keep that in mind. Um, when you're contributing money to nonprofit organizations and you're trying to do it through your business, is that you want to make sure that you understand how those transactions are going to be reported. If you're contributing to a nonprofit through a C corporation, then that's going to be a deduction that you will actually see on the books. Okay, do we have another question?
There was a comment about an extension being made for franchise taxes because the portal was down.
Yes. So, well, it was due yesterday. Now, you're right, they did take the portal down, but also keep in mind that whenever you want to do an extension, and this is something that, every one of my clients, the first thing they do when they come into my office, when you become my client, I have you to pull out your cell phone. I have you pull out your cell phone and I have you to block certain dates, enter certain dates within your cell phone, and I have it to remind you a month or 2 months in advance. And one is when the due date of your franchise taxes. So you never want to wait to the last minute to try to go out because you never know when the portal is going to be down. Now, one thing you can do with the state, sometimes you can ask for a waiver. You can say, hey, your portal was down. I was out trying to file my taxes and I was unable to do that. Can I have a waiver? Can I request a waiver? And sometimes it will grant you a waiver.
Are there any other questions or anything else you want to add? Mr. Marshall, you have a few more minutes.
Uh, as a business owner, and I see this all the time, a lot of business owners, they will try to blame a lot of other people for the downfall of their business. As a business owner, you are responsible for your business, not your CPA, not the person down the block that's doing your taxes, not your tax attorney. You are responsible for your business as a business owner. When the IRS or the state assess penalties, they're going to assess those penalties on you, not your tax preparer, not your CPA. They're going to assess those penalties on you. So, as an owner of your business, you have to understand how your business functions. And, I hate I didn't get an opportunity to share this video. It was a couple of videos I wanted to share with you where business owners have paid millions of dollars in taxes and didn't even owe the tax. That's because they were relying on their CPA or whoever that was doing their taxes. They were relying on those individuals to actually, do their job and have their best interests at hand. Not saying that they don't, but as a business owner, that responsibility falls on your desk. So as a business owner, you definitely want to take this serious. I did also include within here, Kay, a lot of other mistakes I see that business owners make. And that's when you're trying to define if this individual is an employee versus being a contractor. I did put that together, and also I point you back to also the IRS publications on anything that I put in here. I'll have reference back to the IRS publications too as well, where that law is recorded. I think that's all. I see there's another question that's oh, so the other dates that you want to have in your uh, phone is that if you're an S corp, then your taxes are due March 15th. That's if you're an S corp. If you're a single member LLC, then from the federal piece of that, your taxes are due on April the 15th, or if that 15th falls on a holiday, the next business day is due. So for most individuals who were single member LLCs, your personal taxes, because that schedule is filed within your personal tax, then it was due for 2023, it was April 18th. And you can file for extensions. If you're from the federal side, you can file for an extension if you're a S corp, if you are a partnership, if you are a C corporation, you can file for an extension, and those extensions are normally 6 months extensions. The penalties are much different for people who are S corps and also people who are partnerships, because now each individual partner can be penalized for not filing if the tax return is not filed. And that goes the same if you're an S corp with the shareholders too as well. And there are very stiff penalties.
Mr. Marshall, someone said here, and I want to let you all know that the chat has been enabled for your use now. Someone asked, well, how do business owners get continuous education to stay in the know if they can't rely on the experts in the field?
Well, you go out and you search Google is one way of doing that. We offer classes too as well, entrepreneur classes to help you understand your business. A lot of this stuff that I put together today is actually some of the actual documents and stuff that I actually go over with my clients to make sure that they have the correct business setup and that they're educated by their business. When we talked about the employee versus being a contractor, the state of Texas will actually shut your business down. But the federal, they'll just penalize you. The IRS wants to make money, so they would just penalize you. But the state of Texas will actually shut your business down when it comes to not classifying your individual's right that's working for your business. Were there any more questions or?
I see none.
Okay.
This was amazing. This was great. I truly appreciate your time, Mr. Marshall. I truly appreciate it. I am looking forward to, I'm going to call you as soon as this call is over. I'm looking forward to working with you further in the future. And I hope everyone on this call, on this session, can join us next month for when we kick off our franchise program. It will be every week in the month of June. Around franchising your business, the legals around franchising, funding your franchise. And then on the 29th, we will host an in-person meeting with local franchisees and franchisors. So you can get more information on that at gptx.com/smallbiz. I hope you all got the information. We have a question when Mr. Marshall shared the videos you weren't able to view. Mr. Marshall?
Yes, I think the videos are too large. I'd probably have to run them from my system is what I would have to do. But I think that you may be able to go out and Google a couple of these. One was concerning Tyler Prairie and the lawsuit that the IRS had against Tyler Prairie. He ended up paying over $9 million in taxes, overpaying IRS by $9 million. That mistake was a mistake on the part of his CPAs. And so that's why as a business owner, there are certain things that you have to know about your business. And $9 million is not a short sum of money to me.
Definitely not. Well, thank you all for attending. Thank you, Mr. Marshall. And I will send the presentation as well as the survey to you all. Please take the survey. It helps us in putting together future programming for the Entrepreneur U program. So everyone have a great day.